Well, as Charles was saying, good afternoon, and thank you for joining Tyler Duncan Realty Partners monthly podcast on this Friday, April 26, 2024. We having just ended the first quarter of this year, we thought it'd be a great time to focus today with a market update on the two markets that we're most active in, which is the Washington, D.C. and extended metropolitan area, and also the Denver market. So we're going to give you an update on those two markets, and we're going to cover the office sector, we're going to cover the industrial sector, also retail and multifamily. So we'll do Denver first, and then we'll do Washington second. So if you don't have an interest in the Denver market, then you can certainly fast forward to the Washington, D.C. section. But before we get into that, Charles, you were saying hi. Why don't you just mention, Charles, are there any big storylines in the commercial real estate area you want to focus on or mention today?
Well, yeah, it's interesting that, when we do these podcasts, the first thing we do is what are the major news stories of the day? Well, the first thing that really caught our eyes as we were discussing was that we're seeing a 10-year high in distressed property sales. And essentially, from the last quarter of 2023 to the first quarter, distressed property sales have gone up by 11%. What we're hearing from a lot of the mortgage brokers is they're having people calling every day trying to learn about distressed properties. They're seeing opportunities. Next is that, so go on, Chad.
No, go ahead.
The next thing we're seeing is the ongoing increase in the cost of owning residential real estate. So in the last quarter, mortgage rates topped 7% for the first time this year. And I looked up some other statistics that are really, really concerning to me. 22 states, it requires a six-figure income to buy the average house. The other thing I saw was that the average income required to buy a house has gone up by 46% in the last 4 years. So this makes owning a home a lot more difficult for your average person out there. And we see that, Chad, in both of our markets, the Denver and DC, which are expensive markets, and they're both being hit with these high prices.
Yeah, just following up on Charles's point, particularly with the rising interest rates, and Charles had mentioned they've gone above 7% this year. That coupled with some increases in property values in most of the commercial property sectors, we've really seen a significant trail off in sales volume and sales activity, both in the markets that we're active in, but also throughout the U.S. So with that, Charles, why don't we jump into it? As we said, we're going to start with Denver. So why don't you start off and talk about the Denver office market for the last quarter?
Well, absolutely do that. I'm going to get to one thing here because we skipped over one last thing, that Washington, D.C. is the top apartment market for rent growth. And what we're talking about is how expensive it is to buy houses. The beneficiary is definitely the apartment markets. And the apartment markets, although with challenges in D.C. and Denver, both are growing really, really well. So let's talk about the office market in Denver. The first thing we saw that, the vacancy rate has ticked up a little bit since last quarter, is continuing on up, and the availability rate has moved up also. Remember that vacancy is simply how much space has no tenants in it, and availability is how much is on the market. So we really look at both very, very carefully, because if the availability rate goes up by a lot, that could be a sign that vacancy is going to go up in the future. In Denver, you can see tremendous negative net absorption. So this is why you end up seeing high vacancy rates. Now, what's also interesting is that, asking rents are high, and rents grow at an annual rate of 1.7%, which doesn't sound really bad. But think about this. As Chad and I both know, and anyone who's a broker knows, that even though they're asking these high rents, the discounts to asking are great, both when it comes to the base rent, tenant improvements, or concessions. So the actual effective rents are much, much less. also, when you think about it, even though rents grew 1.7%, these are asking rents, inflation is still 2.5%, 3%. So the real rent growth is negative. Now, what this graph is showing us is that the spaces that are currently on the market for lease, everything that's on the market, how long has the median space been on the market? So the median space has been on the market for 14 months. That's a long time. And so that is a concern. Also, now this is a little bit different. How long does it take spaces to lease? So the spaces that have leased, the median space was on the market for 9.5 months. It's now ticked up to close to 11 months. But this is a little bit, the better spaces tend to get leased. So, and they tend to get leased a little bit quicker. But you can see the blue line is the national average. So you can see that Denver's in line with what we're seeing nationwide. And finally, and this is really important, this is a concern here, how long is the median space that is vacant? How long has it been vacant? And it's about a year right now. Last quarter, it was 10 months. So that number going up, is definitely a concern. How long is it taking to lease? How long are spaces staying vacant? A major, major concern. Now, let's go into, construction activity. It's still pretty high in here in Denver. And where are we seeing it? We're seeing it in sort of the go-to neighborhoods, Rhino, Cherry Creek, because these are the places that people want to go. And what's leasing out there? The very new modern buildings with great amenities, the places that companies can attract employees to. Also, and this is a concern right here, is that 40% of the total space under construction is pre-leased. You'd like that number to be a lot higher. In Cherry Creek, almost all the space is pre-leased. So you can just tell, if you're not from the Denver area, you can say, gosh, if all of the new construction is pre-leased in a market, must be a very, very popular market. And Cherry Creek certainly is. Chad, you and I, we're gonna be saying this the whole way through the presentation. Sales are abysmal, and you can understand that. Interest rates are going up. The required rates of return that buyers are demanding are going up. So conversely, the amount of sales are going down. And, so we're seeing this all over this, but especially in the office market, which is hurting so much right now. And, so next we're going to turn on to the industrial market.
Yeah. So before we go ahead, Charles, I'm sorry.
I was going to ask you if you had any comments on the office market before going into industrial.
Yeah, I was just going to mention, to add to what you covered, that we're also seeing a trend today of more loan sales, loans that are tied to office buildings, a lot more volume of loan sales than we would see in, a normal market over the last few years. So interesting trends there. And we suspect that there'll be more of that to come as well. So jumping into the Denver industrial market, as we've mentioned in the last couple different presentations, the Denver industrial market has been pretty strong over the last few years, like a number of different major metropolitan industrial markets throughout the country. But in 2023, and particularly moving into the first quarter of 2024, we definitely have seen some softening there. So like right now, actually for the first quarter, we did see a slight reduction in the vacancy rate from 7.8% down to 7.4%. And the availability rate stuck at 11%. And as Charles mentioned, the difference there is that the availability rate takes into consideration sublet space. Looking at the first quarter of this year, we saw absorption of 2.2 million square feet for the first quarter. And looking at the last 12 months trailing, we saw 4.4 million square feet of absorption or leasing. But as we mentioned, the market's definitely cooling. It started cooling in 2023, and we saw that going into 2024. So as an example of that, right now at year end last year, we stood at an annual vacancy rate of 6.59%. And right now, as I mentioned, as we sit right now in this quarter, we're up into the low sevens as far as the vacancy rate. So in addition to that, we also, in terms of rent growth, last year we saw rent growth in the industrial sector for Denver of 6.2% in rental rate growth. And right now, at the end of the first quarter, we're tracking at about 3.7% in terms of an annual growth rate. So, and that rental growth rate reduction really has taken place, a lot of it in the last 6 months. So it's been, very tepid at best as far as the last 6 months. So, looking at the next few graphs, the story here is that it's taking longer for space to lease up, space sitting on the market for longer periods of time. Similar to the graphs that Charles showed, the blue lines are the U.S. market overall industrial sector, and then the orange lines are Denver. So in this case, we can see that the median industrial space that leased last quarter, it was on the market for almost 4 months prior to leasing. So those numbers, if you look how it's trailing up at the very end of the graph, you can see how these numbers are spiking up. It's taking longer to lease, and space is sitting on the market longer. And then as we go to the next chart, there again, the median industrial space that is currently vacant has been vacant for 5 months. And you can see how that's spiking up as well, particularly for Denver, the orange line versus the U.S. at the end of the graph for the U.S. overall on average. So other key factors looking at the Denver market. So in 2022, we saw 8.8 million square feet of new industrial space come to the market. And then in 2023, that number dropped down to 6.6 million square feet of new space being delivered to the market. And in actual fact, for 2023, a good portion of that, almost 60%, occurred in the first quarter. So new construction has been trailing off, and rightly so, as demand has been slacking off. In terms of looking at sales of industrial space in the Denver area, industrial buildings for the first quarter, we saw 244 million in sales for the first quarter. That was in line with the volume that we saw in 2023. So with that, Charles, I'll just mention that volume from a long-term perspective, looking at the last 10 years for the industrial sector, it's definitely down. So with that, if you have anything to add on the industrial sector, certainly please do. Otherwise, why don't you pick up on retail?
Yeah, Chad, it seems to me that the industrial sector in Denver is healthy. It's just that we're in a business cycle. And so this is the down part of the cycle, but we don't have an overabundance of property out there. Property construction is slowing. And the fact that property is only a market for a short period of time before their lease says, okay, things are slowing down, but this is a healthy market and we expect it to remain robust in the future. That would be my look at it.
Agreed at 100%. I mean, the long-term trends for the Denver industrial sector are very strong. We've just gotten into a short-term period where it's a little bit excess supply and demand has trailed off a little bit. But
right.
In terms of the dynamics of the economy and the long-term trends, that'll work itself out pretty quickly.
Absolutely. So turning on to retail, yeah, it's interesting. I keep on looking at these comparisons with Denver and DC, and they're very similar. Retail vacancy is 3.9%, very low. Availability has moved down to 3.9%. Now notice that vacancy and availability are the same number. That just means that there's just not much out there, and we're really at these almost record lows in availability. Net absorption, 56,000 in the quarter and 683,000 for the last 12 months. Not a lot. Well, why is there not a lot? Because there's just not a lot of space to lease out there. It's very, very tough. So we're seeing smaller numbers. But you haven't seen negative absorption. 11 of the last 12 quarters, we've seen positive absorption. These are good signs that tells me that the market is basically healthy. Now, shopping center construction, low, and it's going to stay low. People are not shopping at shopping centers. We know that. The retail people know that. Rent growth. Rent growth is still low. Why? Because even though there's not a lot of space out there, the spaces aren't flying off the shelf. So rent growth is only 1.1% per year. And also, what we found is that the most successful tenants are not leasing existing spaces. They're going out and doing some other things, which we'll talk about in a second, right here. The tenants are not leasing in shopping centers. They're leasing on pad sites. And a lot of the activity you see, if you're driving up I-25 and you look to the east, you're going to see a lot of stuff that's being built on pad sites. And that's where a lot of the successful retailers are looking to relocate. Any thoughts on that, Chad, before we run into multifamily?
I think that covers the retail sector very well, Charles. In terms of multifamily, the Denver market has been very robust. No surprise there. For the last couple years, Denver has ranked number 9 in the United States in terms of the fastest growing states in the country. So with that, a lot of multifamily developers have been expanding the inventory here in this market. So having said that, right now, Denver is one of the most active construction pipelines for multifamily in the country. So looking at going into 2024, this past quarter, we've got 25,000 units currently under construction here in the Denver metropolitan area. And what's happening is that what we're seeing as we look back over the past year and into this first quarter, the deliveries are getting ahead of absorption by a fair amount. You see with the orange bars, that shows the absorption. The blue bars show the deliveries. And then we've got the green line that shows the vacancy rate. So the vacancy rate has been creeping up. Right now, we sit at about a vacancy rate of 7% for the Denver market. And in addition to that, because the supply is getting a little bit ahead of the absorption, we've seen very slow rent growth. So as we look at the past year and going into this first quarter, we've only seen rental rate growth at 1%. So compared to other national markets, it's been pretty slow in terms of the rental growth rate. Looking at multifamily sales, we saw $939 million in the first quarter. That was in line with the same time for 2023. But overall, that is way down in terms of historical levels. So looking at the level over a 10-year period, that number is significantly less than what we've seen in the past, and that plays into the interest rate increases. We've talked about the higher borrowing costs and also property values, having gotten elevated as well. So with that, why don't we switch gears? And now we're going to get into the Washington, D.C. market. And Charles, why don't you again start us off with the office market for Washington, D.C.?
Absolutely. And our viewers out there, you're going to see two very different setups. And we want to hear from you all which you like better, which helps you out more, so that we can present you information in a way that really does kick in. So DC office, you can see what's happened to asking rents. Negative. The vacancy rate, 16.8%, one of the highest in the country. Who's right behind them? Denver at 16.4%. So you're seeing, really hurting office markets over here. Just looking at the negative net absorption of 4.8 million square feet. So, what we're going to show, what you'll see over here is where has this negative absorption been? It's mostly in the higher quality properties, very low in the 3-star, the 1 and 2 star. But you look at the 4 and 5 star properties, the availability rate, almost a quarter of the market is available for lease. That is huge. The vacancy rate, 20%, huge. Now, what we circled over here was the last quarter, and you can see the vacancy rates are going up. and the expectation it's going to continue going up. And Washington D.C., the high quality properties, they're expecting vacancies. This is from CoStar, by the way. Their forecasters are thinking that it's going to be closer to 27%, which is really high, which means that the expectation is that we're not going to see a turnaround in exactly what's happening in office anytime soon. The rent trends, well, you can see in the last quarter, rents were flat, that negative 0.2%, and you can see very, very low. And then the forecast is for it to go down because it's almost as if it's going to capitulate. It's like we're trying to hold rents where they're at, but now we have to lower it because we really need to fill up this space. And that's what the forecast is going to be going over the next few years. So the other things one thing that Chad and I really look at closely in a market that's hurting is the sublease space. Well, in DC, there's 10.5 million square feet of space available for sublease. And these spaces go for 20% less. And so they're direct competition. One of the reasons why we think we're going to start seeing those asking rents go down is of the competition from the sublease space. The other thing that we're seeing, as in everything else, is the amount of construction, a 30-year low, less than 500,000 square feet of construction broke ground in 2023. Very, very low. That means that construction costs are high and they don't see the demand for the space. Now, Washington, D.C. proper, the city of Washington, D.C. has the highest total amount of square footage. In Maryland, where do you see the most vacancies? Bethesda, Germantown, Greenbelt, which I find interesting, Chad, because you have Bethesda and Greenbelt, which are right on the Beltway, and Germantown, which is way far from the Beltway. So it's sort of interesting how we're seeing that play out. And in Virginia, Northern Virginia, Arlington, Alexandria, those areas are where you're seeing most of the vacancy. Over here, sales volume. And we don't need to say much more. Look in that circle and just see what the sales volume has been for the last 4 quarters. Like Chad and I were talking about for Denver, down. And we're seeing the prices go down, and the expectation that could continue going down are very high. I mean, that is a big slope. Cap rates, they're going to continue going up. As interest rates stay high, the required rate of return that investors need is going to go up. That's going to push prices down. So, Chad, what else are you thinking about for the DC office market before you roll into the industrial market?
Well, as many of our listeners know, the DC office market is highly impacted by a lot of government occupied space. And even the government has pulled back in terms of giving up space and had trouble getting their employees back in the offices. So that certainly affected the market. And I would just emphasize that, as Charles mentioned, and as he showed, the sales volume is way off, it's way down. And really the sales that have taken place have been at deep discounts, sometimes to recent purchase prices, where the properties just traded within the last 3 or 4 years. You've seen deep discounts to those sale prices. So it is a very challenging market that's going to remain that way, mainly just for the office market, really. So switching gears on a much more positive note, the industrial market in the Washington, D.C. and extended metropolitan area, it's a very strong market compared to the national market. In the last 12 months, in terms of leasing activity, we've seen 6.1 million square feet of space delivered to the market, with 2.4 million being leased up or absorbed. Right now the vacancy rate is a very healthy 5%. That's a blended average rate against the various different product types. And over the past year, we've seen an increase in rental rate growth of 6.7%. So very, very strong. So this kind of gets into that information with a little bit more detail. There's a lot of information here. We're not going to go through all this here today, but just a couple highlights. Looking at the second column in where it shows the vacancy rates for the different product types, we can see that logistics type of space is a little bit higher than the others at 5.5%. Specialized industrial, no surprise, it's at 1.3%. That tends to be like a design build for maybe special manufacturing, but it's pretty much pre-leased when the product is built. And then flex is healthy at 5.3%. And between those three, it gives you the average of 5%. One thing that's kind of interesting for the last quarter is that, specifically for the logistics space, the third to the last column in, you see that we had some negative absorption there in round numbers, about 64,000 square feet. So pretty negligible, but still a little bit surprising. We had some negative absorption there. And then the last column shows, space under construction right now as of the past quarter for the various different product types. So you can see that flex space makes up most of that at almost 5.1 million square feet. And then behind it, logistics at about 3.3 million square feet. And in total, we're about 9.8 million square feet under construction. So again, very, very healthy numbers. This shows the vacancy rates by product types. And big picture here is that, if you look at the top line, that's the national market, the black line. And you can see that the national market on average right now, as of the end of the first quarter, is at about 6.5% on the vacancy rate. And as I mentioned earlier, the yellow line is the Washington, D.C. market in average of the various different product types. And that's at 5%. So again, doing very well compared to the national market. So, vacancy rates have risen a little bit in the first quarter, but that has to be considered against the backdrop of, we hit in 2022, we hit a 25-year low vacancy rate of 3.8%. So that's pretty impressive, pretty great statistics. So, right now, logistics space is showing a little bit higher vacancy rate. As I mentioned, as demand has trailed off and supply has ticked up a little bit. So, as I said, the vacancy rate for logistics is at 5.5%. However, just as that vacancy rate is ticking up a little bit, the demand for data center space has hit a 15-year high in 2023, where we saw 5.5 million square feet of data center space leased. And we expect that strength is carried on into the first quarter, and we expect it to carry on throughout the year. So in terms of looking at sales, industrial property sales, so looking at a total asset value in the marketplace of about $64 billion. Over the last 12 months, we saw $1.3 billion in sales. On average, those sales took place at an average cap rate or market cap rate of about 7.5%. So year over year, for the trailing 12 months, we saw a reduction in average prices by about 5.6%. So here again, this data breaks down some of that sales data in more detail. So over the past 12 months, we saw a total number of transactions of 268 transactions. And all those sales combined took place at an average cap rate of about 7.1%. And then in general, we saw in terms of asking price versus the close price or sale price, we saw about a 7.3% lower closing percentage against the asking price. But here again, the overall story as it relates to industrial sales are significantly, decreased volume of sales. So if we look at the next graph here, we can see this shows the industrial sales for the Washington, D.C. area going back to 2021. And we can see the high water mark here with the top line in blue is in 2022 with the most activity. And then behind it, 2021, and in green, 2023. But if we look at the first quarter, it's kind of hard to tell, but at the very front of the graph there, you can see the yellow line. It's, it doesn't cover the whole year. So for the first quarter, you can see where it's trailing behind the other years, kind of tracking the same as 2021. So right now, with just under 300 sales, in the last 12 months, that's about the lowest sales volume we've seen, since 2010. And really, that's a function of, again, the market fundamentals are very sound, but that's a function of higher borrowing costs, and then also a disconnect with property values having risen over the last few years with the strong fundamentals. There's been a disconnect in terms of buyers and sellers on pricing. So that's likely not going to change anytime in the near term. But overall, we expect the industrial market to remain very strong for the Washington, D.C. market. Charles, do you want to add anything to that? And then
I just find it fascinating because you have the industrial market as a whole, which is really, really strong. You have buyers demanding lower prices because they want better returns, and you have owners looking for higher prices because the fundamentals of their properties are still really strong. I think this will all play out because, like we said earlier, I think this is just a cycle for them as opposed to office, which is really seeing some heavy duty challenges. Retail is also, but for very different reasons. So let's roll into the retail side. The first thing I want to show you is the deliveries of new retail space. Less than 1 million square feet over the last 12 months. Not a lot. Fairly good absorption, 1.1 million square feet, very low vacancy, and a positive market asking rate growth, but you're still talking about less, a negative growth when you compare it to or add in the inflation factor. Now, looking at what we're seeing here, where is most of the vacancy? It's sitting in malls. Other than malls, everyone is very, very healthy. So we saw very little net absorption in malls because you're not building new malls. What are we building, more of? The smaller stuff out there. So neighborhood centers had a positive absorption. But overall, the negative absorption, just like we just saw with industrial, low, I almost consider this zero absorption when you're talking about a market of 268 million square feet. So vacancy rates. Basically what we're thinking is vacancy is not going to go anywhere. It's just going to stay pretty much put because we're not building all that much more. Washington is a strong retail market. Retailers are not going to necessarily go out of business. We're looking at stability going forward. So, it's interesting, this first statistic. When we're talking about the retail market, the vast majority of it is sitting in D.C. and Maryland, 91%. If we look at Washington, D.C., the city itself, the availability has gone up, to the highest level since 2010, which is simply a factor of fewer workers working in the city. And every city is seeing these challenges of lower foot traffic. Am I hitting something over here? Lower foot traffic, which is really becoming a problem. The availability rates in Maryland and Virginia are still low, low construction, we're seeing, but as Chad and I keep saying, the cost of capital, land, etc., they are really, really high. The cost of land in DC incredibly high. So you're not seeing as much construction. On the sales side, $1.6 billion in the last year. Cap rates moving up to 6.2%. Not super high yet. The change in sale price per square foot, very low. Not a lot of information to really be gleaned from this slide over here. One of the things when I see this particular graph, my eye goes to the sale to asking price. Negative, 6.8% sale versus asking. Well, when a 63% discount, but I want to see that number on the low end actually in a very healthy market. That's the first thing I look at. Then I want to look at the percentage leased at sales, which is about almost 86%. Now, look at this. When you see, the average sale price you're going to see this up and down number, but you can see that if you put a straight line at $250 a square foot, that's where we've been at. Recently, there has been a little bit of a jump, and I think the reason for that comes in right here. This is a very interesting pie chart. If you look at institutional investors and REITs, they amount to 13% of the sales volume in the last year, which means that the heavy duty big money investors are not putting their money into retail. Who is? The private investors, 61%, and users. A company that runs a company and buys their own building. That is 83% of all the sales. So you can see where this market is right now. It's really in the owner user and the local private investor that really understands the market and understands where the values are. DC, an incredibly strong market. The population has gone up by 39,000 in the last year, which is one of the reasons why the multifamily market, you'll explain that, has really been really strong. But it's affluent. A lot of people come to visit DC. You have government and corporate presence. You have a lot of pluses in this market, which is why we think that the market's strong. It's going to stay put from an investment point of view. It's going to come down to certain fundamentals. But we think that the fundamentals are really going to stay pretty strong throughout the next year. So back to you, Chad. Anything on the retail market and going into multifamily?
I would just add, Charles, you emphasized the high cost of land, within Washington, D.C., and I would just add that really applies throughout the Washington, D.C. and extended metropolitan area. And we've seen the land prices get elevated in the last few years. We've mentioned the higher increased cost of capital several times, but all that, as you said, is playing into making it hard to make sense of the numbers in terms of developing significant amounts of new retail in extended metropolitan areas as well. So,
something that's interesting because the metro area in DC has grown so much. I mean, 20 years ago, do you consider Frederick really a suburb? Not really. Now it's very much a suburb. And going out further, Hagerstown is almost a suburb. I mean, it's really, so you figure it into, well, what's going on out there? And the prices of land have gone up everywhere.
Yeah, definitely. So switching gears, looking at kind of as a wrap up, looking at the Washington, D.C. multifamily market. In the last 12 months, we've seen 14,126 units delivered, pretty strong absorption at 12,953 units leased. Right now, we're sitting at a vacancy rate of 7%. As Charles mentioned at the beginning of our presentation, Washington, D.C. has really seen the strongest rent growth compared to other markets throughout the country. So we saw over the past 12 months, 3.1% rent growth. So this graph shows a few different things. The yellow line at the top is the average vacancy rate for multifamily across in the entire country. And then in green, we see the vacancy rate specifically for Washington, D.C. So, the country, we're at about, on average, a vacancy rate of about 8% at the end of this first quarter. Washington, D.C., we're right around 7%. In addition to that, if we look at the orange bars, the absorption versus the blue net deliveries, we see that, the Washington, D.C. market, let's say, for example, compared to Denver, is much healthier in terms of the balance between absorption and deliveries. So, the factors that are playing into the multifamily market are, as Charles mentioned earlier, we've seen strong population growth with 39,000 increase over the past year. Trailing 12 months absorption through the first quarter of 2024 reached its highest level in nearly 2 years. So again, very strong, very positive. We talked about the increase in rental rates. As while absorption has been strong, looking specifically at this, past quarter, there were 3,300 new units brought to market versus 2,900 absorbed. So that's trending down a little bit, but still, very favorable, very strong. Switching gears on the multifamily market, looking at the the sale component of it. So the total market value is about $172 billion. So in the last trailing 12 months, we've seen about $3 billion in volume trade hands. That's been at an average cap rate of right around 5.8%. We've seen a reduction in sale prices, year over year by about 8.7%. This breaks down the sales data in a little bit more detail, and similar to what we mentioned with really all the other components, the sales volume and the number of transactions from a 3, 4, 5 year perspective is really down a fair amount. So in the last 12 months, we've only seen 111 transactions take place. That's the first column. Those, again, as I mentioned a few minutes ago or a few seconds ago, took place at an average cap rate of 5%, with a low cap rate of about 2.8% and a high of 6.5%. So somewhat interesting. The smaller investors have been more active over the past year, looking at historical data in terms of looking at buildings sold and the number of units that are being sold on average. It's like the first time in the last several years that we've seen the average being under 100 units in a particular project. Again, this plays into the lower sales volume, looking at the last, going back 3 years, going back to 2021. And then we can see that at the very bottom left with the beginning of 2024, the overall volume is tracking lower than the prior 3 years in terms of sale volume. So again, that goes back to, looking at this, again, higher cost of capital and prices, having been inflated. So, overall, the trailing 12-month sales volume is about 55% less than pre-pandemic levels. As I said, the smaller investors are playing a more active role. And it's really been, in terms of the number of units, as I said, that have sold with 100 units or less in terms of apartments, we haven't seen that level of activity since the last 15 years. So with that kind of wraps up the multifamily sector. Charles, do you want to add anything to that multifamily sector before we close it out?
I just find it interesting is that in both of these markets, huge uncertainty in the office sector and real strength and stability everywhere else. The multifamily market in DC, they've been fortunate, but because they haven't overbuilt quite as much as what we're seeing in Denver. But the extra units in Denver, that will be eaten up. I just see really strong markets. The investors have to be savvy, have to know what they're doing in order to make money. You're not going to trip into great deals. You have to have a vision for where you can add value to the properties. And that's what brokers bring to the table, is the ability to ferret out where they can make money in some of these properties.
Yeah, great points. Agreed 100%. Well, as we indicated from the outset, again, we really appreciate you joining us for today's podcast. And as Charles mentioned, if there's anything looking forward that you want us to hit on, you have our contact information, and he and I and our collective team members would enjoy the opportunity to work with you on your particular needs. So look forward to next month. We'll cover a deeper dive into property investment analysis, and we look forward to having you join us for that. Thanks much. Take care.
Take care, John.